This presentation will analyse the potential introduction of T2 into the Canadian market, taking a range of factors like its economy, population demographics, and consumption patterns into consideration. It will be concluded that entering the Canadian market is a great opportunity for T2, despite there already being established tea companies to compete with. The first T2 store was opened in 1996 in Fitzroy, Melbourne. It's been described by the founder as being born out of a desire to be unlike anything else, to break the mould and challenge the way things are done. It's not surprising that it sells innovative tea, which is upmarket. In 2002, T2 launched its wholesale arm, and customers could find its teas in cafes, restaurants, and gourmet grocers, in addition to its stores. 17 years after it was founded, and at a time where it had 40 stores, T2 was acquired by Unilever, who owned other well-known tea brands such as Lipton and Bushels. The following year, T2 opened its first international store in London, with others following in New Zealand, New York, and Singapore in 2017. A variety of countries supply its tea, while most of its packaging is done in Morocco, Germany, and Poland. The success of T2 can be attributed to several factors. Firstly, its in-store customer experience. Its business strategy is very much about giving their customers an in-store experience in which they can play, discover, and experiment with the staff. The welcoming atmosphere and free samples contribute to customers returning even when they might not actually intend to buy anything. Next is its innovative upmarket products. A significant portion of the 100 teas available are one of a kind, which it's constantly releasing. These upmarket blends create a separation between competitors and often include unusual flavours. For example, for its store opening in Singapore, it launched a new tea called Singapore Breakfast, which had hints of coconut and pandan, both culturally popular flavours in Singapore. Lastly, its focus on the environment and sustainability. T2 markets itself as being conscious of its footprint on the environment. It openly planned to have 100% certified sustainably sourced tea by the end of 2019, 100% certified ethically sourced teawares and accessories by the end of 2019, and only use recyclable or reusable packaging by the end of 2020. The above factors all combine to set T2 apart from its less innovative competitors, and therefore increase the willingness to pay of customers for its product. Founder Marianne Shearer says, "We love tea. That's what we do. We don't sell tea. We don't have a tea business. We just love tea, and I think that's really important. We modernised it and took it to a different market."
As shown in the accompanying chart, Canada has had 3 recessions since the mid-1950s, starting in 1981, 1990, and 2008, each of which lasted for about 1 year. These recessions were met with annual declines in real GDP of 3.3, 2.1, and 3.0% respectively. As evidenced in our growth accounting table, decline in real GDP was led by lower unemployment and lower working hours in each of these scenarios. Along with low population growth, this contributed to a sharp fall in labor utilization rates. During periods of expansion, Canada's growth was led by a growing capital deepening ratio, also supported by steadily increasing labor productivity rates.
Understanding exchange rates between Australia and Canada assists in making key operational decisions aligned to a market entry strategy. In 2019, the PPP exchange rate between Australia and Canada was 0.82, whilst nominal exchange rate was 0.92. Historically, the nominal exchange rate between the two countries has been relatively stable, fluctuating between 90 cents and $1.05 since 2010. With consideration to both the PPP and nominal exchange rate, the real exchange rate between Australia and Canada was 1.13, suggesting that Australia is 13% more expensive than Canada, or conversely, it is 13% cheaper to produce goods in Canada than Australia. The real exchange rate, together with T2's business strategy requiring localised retail operations and its access to Unilever's global supply chain, support entry into the Canadian market.
Canada has had no periods of default at a federal level, and based on its 5-year credit default swap rate and AAA bond ratings, the risk of default is quite low. The impact of oil prices has, however, caused the Canadian government to increase its debt levels beyond recommended limits, which one sees in the beginning of this COVID crisis. The slide also shows high and rising levels of household debt, which our organization will continue to monitor. Canada has seen no periods of rapid depreciation or appreciation in recent history. As previously mentioned, Canada's federal budget depends in part on the price of oil. In the table of periods of note, those years with moderate depreciation has been driven by low oil prices, which cause the value of exports to decline and make the Canadian dollar less attractive. That said, despite short periods of moderate volatility, we believe that there is no risk of sudden devaluation.
Monetary indicators provide excellent insight into the strength and confidence of Canada's banking system, whilst more broadly indicating consumption and lending behaviour. Within Canada, currency drain has consistently declined since 2000, whilst reserve ratio has held steady below 1%. The observable trend in indicators suggest confidence and trust in the banking system, whilst suggesting favourable consumption and lending conditions to further support market entry into Canada.
Canada's current population is measured at 37.7 million people, which ranks it as the 39th most populated country in the world. Canada has recorded consistent positive population growth over the last decade, which has largely been driven by positive net inward migration. So, whilst the birth rate of Canadians isn't high enough in itself to drive growth, Canada's position to welcome migration is enabling its growth. It is also worth noting that Canada is one of the most sparsely populated countries in the world, so there's scope for commercial growth for T2 in this market. It is currently forecasted that Canada will reach 50 million people by 2070. The average salary in Canada in 2019 was 52,600 Canadian dollars. Not unsurprisingly, the key drivers of wage level in Canada are experience and education. Also, the stats do unfortunately show a gender pay gap in Canada, with male employees earning on average 5% more than their female counterparts. Overall, the Canadian employment environment shows steady growth, with employees averaging 2% wage growth every 12 months. Though there are a few industries in particular that outpace the average, namely the forestry, IT, and mining industries. This steady growth in wages promotes an environment where premium consumables like T2 can flourish. From a human capital perspective, the World Economic Forum in 2016 ranked Canada as 9th out of 130 countries. This is a measure of a country's ability to develop and utilise its talent. And in particular, Canada's strength came through the quality and access the populace has to its education system. In expanding to Canada, we note a range of potential market competitors for T2. We flag David's Tea as one of these. David's Tea has 240 stores across Canada and the US, and produces 150 varieties of tea that appeal to a wide consumer demographic. The success of David's Tea shows an appetite for this industry within Canada, and presents an opportunity for T2 to compete for market share. We also note that in Canada, there appears to be a rich culture of small independent retailers. T2's product range is so wide that it will likely appeal to each of these niche markets. T2's engaging shopping experience will also suit these customers. And finally, we note that the Unilever Group has a variety of teas in market around the world. However, we believe that T2's entry into Canada does not cannibalise these existing brands. T2 is Unilever's only brand that presents a standalone retail outlet to the consumer. So rather than cannibalising existing sales, we see T2's entry into Canada as an opportunity to gather market share by reaching new customers.
Risk assessment identified 7 specific areas with risks spread across low, medium, high, and extreme categories. COVID-19 has a significant impact on retail industry. We have categorized this as an extreme risk in the short term. We believe T2 can mitigate the risk by delaying the market entry and having a strong emphasis on e-commerce. Canada has a competitive coffee market with popular brands such as Tim Hortons. Canada's coffee market is more than double of its tea market. While this is a high risk, T2 will be able to mitigate this with strategies such as market segmentation, positioning the product, and perform marketing campaigns targeting the segments. There are 4 medium-level risks. Canada has strong exposure to United States economy. Canada has strong economic bonds with Group of 7, which Australia is not part of. T2 can consider partnering with Canadian, United States or European partners and suppliers to take advantage of their relationships. According to the World Bank Group, Canada's ranking for contract enforcement is surprisingly low. Canada is ranked 100th compared to Australia, which is ranked at 6th. By investing in getting the contracts with suppliers, vendors, and retailers right from day one will minimize potential lawsuits. Tariffs in Canada vary depending on the origin and the classification under harmonized commodity description and coding system. Imported goods are also subject to goods and services tax, which includes 5% federal tax, plus varying rates in each province, which can range from 5% to 9%. It is recommended to identify the most appropriate tariff and regulations that apply to T2 and organize the supply chain to maximize profitability. 66% of Canadians buy their tea from the supermarkets. It is important to have a strong supermarket presence as well as making T2 available in novelty stores. Canada's culture is largely like Australia. Both countries are English-speaking countries and are members of the Commonwealth. One contrast of note comes in Quebec, the second largest Canadian province, where 78% of people speak French and 50% speak only French. While this is a low risk, marketing activities will need to cater to both English and French speakers, which may impact capital and operational costs.
As has been outlined, the introduction of T2 into Canada is a natural choice when seeking to increase its international presence. Although some limitations have been highlighted, they do not override the view that there is a great opportunity waiting for T2 in the Canadian market. The key indicators in favour of the investment are favourable growth metrics including high labour productivity, a strong and historical stable currency, a health-conscious population, high interest economy, and a growing preference towards herbal and fruit teas. But there are some key considerations that must be made. There's already existing competitors, and there's been a decline in the personal tea consumption. We thank you for listening to our presentation.
See you later.